Good morning, everyone. It is April 10th, and it is about 30 minutes before the market has opened. It was a glorious day yesterday where stocks on the NASDAQ rose more than 12%, which was a really big increase. It's probably one for the record books. I don't know that it's the biggest rise in one day, but it was certainly a big rise. And overall, it really helped get the market closer to even. Where we got a ways to go. Yesterday, when the market opened, the Nasdaq was down about 24%. So now we're kind of making progress on that from the high to where it's at now. It's 14%. So we're getting a lot of the losses that we had for a while. If you look at the Nasdaq from the top to its lowest point, it was down close to 24%. And then yesterday was a big move towards getting back to even on that. Now, a day like that, I could expect that today we might open down because, geez, that was just a big move. And some investors may want to liquidate a few of their positions, gives them a chance to do so. I have to admit, I sold a few stocks, a few shares yesterday. I'm creating a little more cash. I sold a little bit of my Bitcoin and Ethereum. Hopefully, I don't get a lot of bad comments about that. But my intent is to rebuild some of that cash. And I built up some cash in late 2024. Glad I did so. And it gave me some dry powder to use over the last week and a half, especially. I've been buying some shares in some really good companies, and I've been getting a really good discount, but I can't do that unless I have cash to buy those stocks. So getting a little more cash is not a bad idea. We'll see where the market goes today and see what it has to offer us. Overall, the around the world, Asia, the Shanghai was up a little bit. And what's interesting is it wasn't up higher, but I think the tension still remains between China and the US. That's the one tariff situation that didn't get fully resolved, but I think they're going to work on it. I think they're going to have a lot of exemptions too, like Apple will probably be exempt. So that's a big part of the trade between the US and China. So, but in Japan, it went up 9%. Wow, that's incredible. And then I believe this is the Hong Kong exchange was up 2%. So that looks good. Europe, it's down. You double check that. So it looks like Europe is up, and that's what I expected because, such increase in stock prices in the US is probably just really good news that they're waking up to and trading off of it. So in Germany, they're doing well, and in Britain, they're doing well, and then in France. So things look good in Europe. Over here, we've got a market that's probably going to open down. Not a big deal. Again, probably just giving up some gains. Some investors probably just wanting to lighten up on a few stocks because prices increase so much they can, get a little cash going. So that's what's going on. Crude oil did rise yesterday quite well, and now it's settling back down. So that is interesting. Interest rates. So I got a little conversation around interest rates. So we had some economic data this morning, and it was good news on the inflation front. Inflation was lower than what was forecasted. So lower inflation, everybody wins. If we have lower inflation, cost of goods stay down, that's great. And those items are going to benefit everyone. And it also sets up a higher expectation that the Federal Reserve is going to lower interest rates. So that is good news all the way around. So the news on inflation was positive. So that's what I expect there. On the fear gauge, this thing got down to 4, which was pretty darn low. And now we're up to 16. So we're still in the extreme fear gauge, but nowhere near 0 again. And we'll see if we can get closer to neutral, but that's going to take a little time. We're still in a zone of, a lot of news can really move the market. And if we have negative news, it can really move the market. We're going through earnings, and I think that's what could really move the market as we get into the big ones. So good morning, everyone. Let me say hello to everybody. It looks like Shadow Guy. Good to see you. Now you're tracking monetary policy and bonds. Good. Very good. Android PC, good to see you out there. And Bushy 1147, good morning. Thanks for your support, and thanks for your support, Shadow Guy. Thanks for being members of the channel. I appreciate it. David, good to see you. Good morning. Sergio, good to see you. And if you're not a member, please consider being a member. You can easily get more information, get signed up. You just go to the home page of the channel and you click on the join button here, and you're off to the races. You can get all the information you need on becoming a member. And if you're a paid member, you on the streams, you get highlighted. You can ask for stocks to be reviewed. You can attend investor only calls, and you get access to the tools that I used. And I just updated the analysis sheet, which means all the reviews that I do every month, and I update them, daily. You get a copy of that. It's updated once a month, but you can look up a stock and kind of reference the work that I did and use that in your analysis. So take a peek and become a member. I think it'll be worth your dollars. I think it's a few dollars to get signed up, and I would appreciate the support on that. All right, so I wanted to move from there to earnings. So today we don't have many big earnings. We have CarMax. I'm going to take a look at that. Maybe we'll look at Byrna Technologies as well. But tomorrow, that's a big day tomorrow. JP Morgan, Wells Fargo, Morgan Stanley, BlackRock, Bank of New York Mellon. This is going to be huge because they're going to talk about the economy. They're going to talk about what they're seeing. We're still kind of like shell-shocked over the tariff scare, and we're still in it. I mean, they haven't resolved the tariffs yet, but I think tomorrow is where this is going to be big. I'm going to try to live stream in the morning, and we'll go over these. All these are before the market opens, so it might be a little longer live stream tomorrow. I'll take a look at all these stocks, and we'll see what we're faced with. And this is going to influence the market. It's going to move the market up or down. And then next week, we're just getting started with earnings. It's going to get huge next week, and it's going to be bigger the week after. And we're going to stay in a big zone for a while on earnings. That's what's going to move the market over the next month. Mike, the dividend investor guy, how are you? So you got more items on your shopping list, huh? You want to add more Meta, CRM, United Therapeutics, Zscaler, and Adobe. Yeah, they went up. Meta went up nicely yesterday. CRM, one thing I've noticed about CRM is that it's held its value really well on really down days. I was seeing that CRM wasn't going down with the rest of the market, which is good. Adobe is just really discounted, and the Zscaler is doing well. So I can understand that the prices are more expensive now. I appreciate your support, Mike. And the Magical Self, thanks for joining. If you'd like me to review a stock, please consider being a member or buy a $5 super chat, and I can put that on the list. So please consider those two options. All right, so we have earnings coming up, the big ones tomorrow, but for today, let's take a look at a few stocks. I've got a stock that a member wanted to look at, which is NBIS. Let's start there, and then we'll come back to CarMax and maybe take a look at that other little company. So Nebius Group is NBIS, and these guys are in the data center business where they've established a data center, and let me show you kind of a few pics here. They run data centers, and they are really trying to focus on AI workloads. These are high performance workloads where um, businesses or companies that are maybe trying to create a really interesting AI app will go there and they'll get these high performance infrastructures. And they claim to really have the Blackwell, the NVIDIA Blackwell knowledge and have, it working in their data centers. So that makes them a little different. And I looked into them, and it may be hard to invest for me, and I'll show you why. Is when we look at this company, and I looked at their most recent announcement, um, they are heavily investing in their company, and it's creating a lot of negative cash. They're burning cash and losses. They're not profitable. And data center hosting is right now there's a big build out, but is it going to be profitable? It's a little bit of a gamble, and it's not as lucrative. Hosting data center hosting is not as lucrative as, let's say, um, Zscaler, where Zscaler makes 80% margin on software. You develop, a working software product. It's intellectual property, and you can sell it to 1 million customers, and your cost per unit sold doesn't really go up, and you actually get more profitable as you get bigger. But infrastructure companies, as you get bigger, you have to buy more infrastructure. You have to buy more from NVIDIA, more from all the different data center product companies. So there's a variable cost on incremental customers. It's not like you get to a certain scale and then you get more profitable and generate more cash. So that's one of the limitations that I have on Nebius. So they are a young business, and they are losing money, and they're burning cash. Um, I think they're growing, and that's great. But as I've said before, and I'll kind of put these guys on my desirability quadrants, and I'll explain where I put these guys in a bit. But when we look at their cash positions, a little bit light, by the way. Look at the cash. A year ago, they had $2.449 billion of cash. They're down to 116 million. So that's red flag number one. The other red flag number two is they discontinued a business. So I didn't have time to look into them all that closely, but I think they pivoted. They were doing something before, and then I got opposite dates. Sorry. Thanks for clearing that up. So they've increased their cash. It looks like, I think they issued out their stock in the US, and they've accumulated some cash. But one thing I did look at was the revenues are increasing really well. They're losing money. And if a company has losses on the income statement, that is not a showstopper for me. But what is the cash burn. And I could see that more on this view here. And cash is being burned over the last 3 years. They were cash positive back here, but I think that's before they were an AI company. Now they've been burning cash, and they don't have the latest statement of cash flows, so I don't have any detail there. But this is where I can't put a value on them because it's negative cash, and they're losing money, so there's no earnings per share. So this one here, it's really your decision on, top line, and, are they going to grow that data center business, and is it going to be really desirable? And when I look at a business like this, again, I don't quite like it like I do a Microsoft business or a DocuSign business. It's it's a business that, is going to constantly need more capital. If you make it bigger, it's like a restaurant, right? Restaurant never establishes super scale. Like McDonald's is probably the closest to having scale, but even they don't have incredible margins. Like Adobe has 89% margins. That's incredible. And the restaurants have to continue to buy ingredients, pay employees, and make the food for customers. Data centers have to constantly buy more gear, buy more expensive, processing and computer equipment, put it in their data center and provide the services to their customers. And they have to have skilled employees to manage that infrastructure. So these guys are solidly in the gray, and I would put them probably, this is based on free cash flow and profitability down here. I would put them on this side, which means they probably do have a way of differentiating in the market and attracting companies that really want specialization around AI for a data center. I'll give them that much, but I'm not going to put them in the green. Up here is Meta, Google Alphabet, Microsoft, those types of software companies, intellectual property companies. They make a killing on margins. And the margins is where I think Nebius, and I don't know that I looked at margins, but let's take a look at now. So the gross margin of 37.5, that could probably get a little better, by the way, because I know they're growing. And as they get bigger, I expect that to grow a little bit, maybe get up to 50%. But that's nowhere near like software, like 80, 90% margins, or pharmaceutical, 80, 90% margins. That's the kind of stuff that is really what I'm after. Or I buy into a business that has 40, 50% gross margins and I get a really good price. And it's a really solid business. I don't see a ton of risk. Where here, my other big red flag is Nebius is competing against some pretty big companies out there. AWS, Microsoft Azure, Google Cloud. I mean, if I get to pick my competitors, it wouldn't be those. I'd like to see some competitors that are weaker. But in this case here, that's what they're dealing with. So for me, it is a sell. It is a pass. It is I don't want to invest in this. I am an investor in Google Cloud, Google, I should say, and they own Google Cloud. I'm an investor in Amazon. They own AWS. And those guys are doing great, and they're picking up a lot of AI business, and they're a diversified company, right? Like Amazon, yeah, they have all the capital they need because they have that e-commerce business, and they have all kinds of other businesses, and they have the established cloud business where they're performing great. AWS is probably arguably more valuable than the rest of the business, but the e-commerce business is really valuable. So Amazon's great. And then so is Google. So those are my comments on Nebius. I would prefer, and if I'm gonna dive into the data center, and I'm gonna go small because these guys are small, I'm going A-Lab. Here's why. So these guys are 10.4 billion, small. Growth, incredible. Okay. Now these guys are in the data center, but they're selling a semiconductor that helps with the communication. If you have a company that has multiple clouds, meaning they're running workloads in AWS, they're running workloads in Google Cloud, but they need those applications to communicate with one another. And their technology is what provides that. And that's a very sought after, in demand technology right now. which is why they're growing so darn fast. And you see that the data center is growing. These guys are growing with it. So that type of incredible growth, and we look at margins, 76%. Now, semiconductors are the type that you control the intellectual property, and you have these semiconductors manufactured by predominantly Taiwan Semiconductor. And you do get these incredible margins. You look at NVIDIA's margins, they're way up there. 76% margins, 242% growth. So this is where I'm putting my capital, as Astera Labs, because they do have something that's unique in the market. I would not be surprised if these guys get acquired because they're small. They have something special. I could totally see like a Broadcom, an NVIDIA, some big semiconductor company going after these guys because they do have something that's working. They were up almost 20% yesterday, and boy, their stock chart is just hard to believe. Down 51% year to date because they were up so much and they came back down. But overall, the 5-year. So this is an interesting little company. This has more of enough evidence that these guys could just really take off. I mean, this could be $100 billion market cap business, in my opinion. And that's why I'm getting involved is, I don't see, and this came up in a live stream, by the way. So I could thank the community for this one. But when we looked at it, I'm like, whoa, I don't get to see 242 in growth all that often. So good stuff. And Mike, thanks for asking about NBIS, getting my thoughts in the data center. I think there's money to be made, but remember, there's no rule that we have to buy one stock. There's no rule that I have to buy CarMax. There's no rule that I have to buy Nebius. There's no rule that I have to buy Astera. I get to pick the best one. And for me, Astera is the best one. So thanks for asking, Mike. All right, we got a super chat from Levi. Thank you so much. Appreciate it. Let me get to your stock here after I check comments. So you want to look at AMR. What's AMR? AMR. So I'm going to look at AMR. Give me a second. Let me just check on comments here. All right, good. I think I'm up to date. All right, let's keep rolling. And AMR. Okay, Alpha Metallurgical Resources. And I think this one came up because what's that super investor that owns these? I think it's Monish Pabre owns them, and Guy Spire also own them. This business, because I took a peek at them, I think a week ago, they're not doing all that great from a stock perspective, right? Year to date, down 42%. 1 year, 63%. 5 year, up 3,140%. Wow, incredible. The buying was great when they were like $3 and they were down to way down in stock price, which is always, kind of hard to invest in a small dollar company because there's not a lot of confidence in the business, but now there certainly is a lot of confidence. So is this worth considering? Let's take a look. So the market cap is 1.5 billion. This is a company, Alpha Metallurgical Resources, a mining company, produces, processes, and sells met and thermal coal in Virginia, West Virginia. The company provides metallurgical coal products. It operates 20 active mines and 8 active coal preparation and loadout facilities. The company was formerly known as Contura Energy and changed its name to Alpha Metallurgical Resources in February. Okay. So they're getting coal out of their mines. The one thing I want to make sure I understand is Is their coal being used for energy or is it being used for steel? So this is their mining operation in Virginia, West Virginia, and Tennessee. And I'm not getting the answer to that question, which is there steel going? So metallurgical resources, metallurgical to me means that it's being used for steel. Let me just make sure. Yeah. So metallurgical coal is made for it's in the steel making process. Okay. So that's what they're in. Now, I would think that domestically sourced materials to make steel are a good thing right now because you have tariffs, especially tariffs to protect the steel industry. So, high level, big picture, I'm like, well, these guys ought to be doing well. So, what's the deal? How come over the year to date, these guys are just getting crushed? Interesting. Well, let's take a look at their fundamentals. Maybe that'll tell us. Forward P is 6.48. All right. And price target's 188% higher, maybe. Okay. So now we've had a decrease in revenues. And I know that commodity prices have been dropping. Steel prices have been dropping. It's not that these guys are doing a bad job and not excavating quickly enough and so forth. So it's mainly the commodity price is down. And so that's what's going on there. Let's look at the quarterly. So the quarterly is even worse. It's down 35% if you compare the fourth quarter of 2024 versus the year before. Okay. So, so the commodity price is down. Okay. Now, when we look at earnings per share, they do make money. That's good. Free cash flow is there. Very good. Their free cash flow is really good in 2022. And that's back when commodities, we had those supply chain constraints and so forth. Material costs really went up. Even with the lower rates, they're still making free cash flow. So good job. All right. So they do produce very good free cash flow, 381. And these, I'm giving it some thought. Let me look at the amount of cash they have on the balance sheet versus debt. Man, they have very good balance sheet. Look at that balance sheet. Cash, 481, debt, almost nothing. This resembles like a really strong technology company or pharmaceutical company where it's like, we have no debt. We just have cash. We produce cash. So these guys are worth, I would say 2 to 4 billion. And the reason I'm going to say a range is that this forward PE, the market doesn't have, is not in love with coal mining and, steel production. But I would say that I've been buying into materials, and these guys in materials, yeah, because materials have been working, and we have these tariffs. And big picture, I think tariffs are going to cause some friction, additional friction in trade. Additional friction in trade may cause commodity prices to rise. So that would be a good thing for AMR, in my opinion. This is an interesting stock. And let's kind of jump into a full evaluation of this one. And I'm going to compare it to BHP, which is a stock that I already have. You can't see another screen, but I'm going to open the page that I'm showing on another screen so I can get the details and then put them into a valuation. So we're going to compare these guys to BHP. BHP is a little different. And right now I own TX, which is in the steel production business, but they're a little more vertically integrated. Not only do they mine the ore, they also produce rolled steel, where the type of company that AMR is more like BHP. BHP just is a materials company. They mine it, they get the raw commodity, and they ship it out predominantly to China. Now, the difference is BHP has a fairly sizable copper mining operation, and that's why I bought it. Copper is a huge necessity for the types of products we make, right? If you make a semiconductor, you need copper. If you make electronics, you need copper. You want to build a house, you need copper. It's a very important material for just about everything. So that's why I like BHP. But let's talk about AMR and see if it's a good stock. Worst case, just to make sure we're keeping up with it. Look at that. I can't even type this morning. I need another cup of coffee. And I'm just going to keep it at AMR, make it easy on myself. So BHP is down in Australia. It is a little riskier for me. It's still discounted, even though I use an 11% discount rate. I'm going to lower that guy to 10. And the reason I'm going to use a higher discount rate is the market doesn't really value and appreciate these material companies. It's like, man, they got to do something incredible to get the market's attention. So I'm going to use a 10 there. I'm going to use the trailing 12 months of cash flow, which was, I think, 361 million. And I'm going to look it up here on the other screen. 381 million. Okay, so now I think that commodities are going to go up. Commodities have been low, especially on the steel side, for quite a while. So I'm going to actually take that 381, improve it by 10%. And these are decisions that I need to make as an investor, right? This isn't, what's fun about investing is you take things that are very definitive, quantitative, like, the mathematics that you're seeing, but you also need to inject decision making. And what's my expectation on these material markets? I think they're going to go up. So that's why I'm influencing the numbers with what I think is going to happen. And on your side as an investor, you need to establish that type of knowledge and ability to make decisions for industries that you're going to cover. You can't be a master of all industries. So try to research industries and be able to make decisions for yourself. In the case of materials, I have the knowledge that I picked up while researching BHP and TX, and now I'm making that judgment call on growth. All right, so we saw that they had some cash on the balance sheet, and I was impressed, by the way, with the amount of cash on the balance sheet. To me, when I see cash on the balance sheet and no debt, it's a sign of a strong business. It's like a strong household that has no debt. They just have assets. That just shows that, hey, they're not going to struggle as a household. And this company is not going to struggle as a company. They are going to be able to weather a downturn in their business. And then at some point, the business, when commodity prices go up, they're just going to be flush with cash. All right, so shares outstanding, 13 million shares outstanding. I think everything else is fine. except for market cap is not correct. And that is so this thing's heavily discounted. Man, why is the market not valuing AMR? And that's where, this industry, materials, it's a little bit of, the numbers show you one situation or value the company at a certain level. And it might be a good time to look at a company like this because the cash looks good. I think it's going to get better. And they have really good cash on the balance sheet. So this is a strong business. So this one here is looking like a buy to me on cash. Now, when we look at, and I'm going to show my screen just so you can kind of follow my train of thought. We have one analyst in the stock, and I did do a super investor video on Prob A. He's into materials big. Now he's losing his shirt this year. He's the worst performing super investor I'm tracking. So if he sticks to it and this thing comes back, he may be the number one super investor ranked on my little ranking. But these guys have an earnings per share of 18 for the current year. That's great. $18.13. And what was their dividend? So they don't have a dividend? I would have expected they would have a dividend. So that's a great earnings per share, 18.13. Okay. I'm going to go with a 6 PE, and I'm going to grow that by 10%. So fairly priced on earnings per share. This thing's discounted all day long. And right now, materials, these tariffs, if anything, lead me to believe that natural or domestically sourced materials are probably going to be a good idea. And AMR is probably going to feed US Steel and all the different steel manufacturing. Now, I would not expect that they're going to be exporting their coal because it's just so darn expensive to move it around the world. So you have to have a customer base that is going to take your material, without the transportation being a big part of the cost. You can't put it on a bunch of ships and ship it around the world is what I'm trying to say. So this one here is, I'm not sure why the market's selling this one off, but I think it's a buy. AMR looks good. Even if we said, hey, we want a really high rate of return, it's still discounted. It's got a solid balance sheet. This one may take a little time to wait around for the stock to start working again, but it's shown that it's worked before. And if we catch a commodity rally where the price of their particular material goes up, this stock's just going to fly up. For now, I don't know that it can go any further down because it's a valuable company. So I'm going to watch this guy. I might even buy it because I think it looks good. So let me put this guy just to remember that I need to come back and update my AMR. But thanks for asking about that. And hopefully this helps you understand the business a little more. You have one more opinion on the company. And I appreciate the question. I appreciate the super chat. Thank you so much. Who asked that again? That was Levi. Thank you. All right. So moving on. Magical Self, Mike. Shadow Guy. Have I ever looked into OKLO? Yeah, let's take a look at it. And Genetic Smite, good to see you. And then Saburox, very good morning. All right, so let's take a look at OKLO. And before I jump there, what's the market doing? It opened lower. All right, as expected. Okay. No big, no big, so long as it doesn't crash 12% and take away the big gain from yesterday. I'm fine with it opening a little lower. um, so we'll keep an eye on it. Okay, back to OKLO. They design, develop fission power plants to provide reliable commercial scale energy to customers in the US. It also provides used nuclear fuel recycling services. The company was founded in 2013 in Santa Clara, California. Okay, so this became really interesting as the big picture story of data centers are going to need a lot of power. We're going to need to develop more electricity infrastructure to produce more electricity. So let's take a look at the numbers and see what this company's worth. So over the past year, this business has gone up 40%, not too bad, but at a certain point, it was flourishing, right? It was really up there. And I think the story of how data centers are going to need power is getting ahead of itself. I mean, look at this stock. Geez, it really flew up. It went from $10 to $55. And so here's kind of some common sense that I kind of throw at this. And I could be wrong a little bit, but I don't think I'm completely off. So data centers are already scaling up. We just saw NBIS. I was talking about AWS and Microsoft and Google. Their data centers are really expanding fast, and they're putting on big workloads. You got OpenAI, you can go to it and ask it questions. You can go to Gemini from Google, ask it questions. Meta AI, DeepSeek, everything, right? Well, I hear no general news that, oh my God, we're running out of power. No. And I live in California. I would say it was in the George W. Bush administration. So that's going back, I guess, about 15, 20 years. That's about right. We did have shortages of power in California, but they were predominantly caused because we were in a situation where the power is actually being diverted away from California. It wasn't that we didn't have the power to power California. Now, I don't hear of any power shortages. So the whole story around nuclear is going to be a necessity. Now, I'm in favor of nuclear, by the way. I've studied it a little bit and know that nuclear could be very safe. It's actually very safe for most countries that use it. I know we've had some bad accidents, but I think it could be a really good part of our future. Totally agree with it. I'm just not caught up in that story of, oh, the data center. The other thing that's flawed in that story is that these nuclear plants, you just don't create them and 6 months later you're producing power. It's a long, arduous process to make sure it's going to be safe, make sure it's built for it to be safe. I consulted to a company that manufactured pumps, to pump water, to pump oil, any kind of liquid. And the price on a pump that would be for, let's say, water, just to pump fresh water, would be literally like $100. And then they produce pumps that would go into nuclear power plants. And a similar pump, when you looked at it, would cost like $5,000, $15,000. And it was like, whoa, why is that? Well, they have to make sure that all materials are certified, inspected, and then each step of the process, the product is x-rayed to make sure there's no cracks or flaws. It's super expensive. Every product, every step of the way, they want to make sure there isn't going to be a failure that's going to cause an accident. And then that accident causes an emission of radiation. Nobody wants that. So building these power plants take a long time. These guys are $3.2 billion in market cap. Right now, they produce very little revenue. Actually, these are all expenses. So they don't produce revenue. So they don't produce revenue. It's just costing money, which, they're trying to get things sorted out and built. So they're burning cash. How much cash do they have? Now that big run up, so they have $227 million of cash, $1 million of debt. Perfect. So they have a fair amount of cash available to fund the creation of this business. Okay. So let me go over to their website. So they're headquartered in San Jose. Now the idea is out there that instead of, like, I guess 50 years ago, or maybe even longer, 50, 60 years ago, when nuclear was being built, they would always think big, like, oh man, this thing's so hard to build. Let's build it big. And 3 Mile Island and, places like that. But I think the new concept is, no, let's go with small reactors, and you could actually have a small reactor next to a data center, and it fuels that data center. That makes sense. Okay. So these guys are totally like a long-term investment. If you believe in this company, you believe in the space, and you're going to put money into it, but it might be 5 to 10 years before you see a good rate of return. And it might be 5 to 10 years from now before you realize this isn't going to work. Because I think it's a good idea, but there's so many unknowns. Is it really going to work? Is a competitor going to come in and do it better than Oklo? If so, then Oklo is not going to be competitive because somebody else came into the market and they can do it twice as fast for half the cost. And like, oh no, we're never going to sell our technology or be able to build these, power plants because our competition is better. So those types of things, I think this is a idea generator kind of company, and they're not producing any revenues. I would study the company and try to understand. They have to be communicating, when do they expect to start generating revenues? Is it a year away? Is it 5 years away? What's going to be the way to monetize what they're doing? That's really important to me as an investor. I think it's great what they're doing, but at this point, I would not be investing in this company just because there's just not enough there for me to see that, hey, like, it's one thing to see a company is already in the revenue generation phase of their company existence. They're not quite profitable yet. Maybe they're not even cash positive yet, but I see that the margins are good. The growth rate of the company is really good. And I see that in a year or two, they're going to be cash positive. That's how I entered Uber. Uber was like, hey, they're about to become profitable. They're about to generate really high free cash flows. And I got in early. So that was a good move. So I'm not against that, but we're not even close to that here. They're not even generating revenue. So I really want to understand the whole business plan that they have. And at what points are we going to see the monetization of their business? And how is that going to look? Do they expect certain margins? I mean, those are things this company should already have. If they don't, then I'm even more concerned. I'm like, guys, this is like a pet project. If you're not out to make money, then I don't want my capital involved. It has to be a great idea that is going to have great return on investment. If it's not the two things, man, I'll just be a fan of your idea, Wish you well, but you're not going to use my capital. So those are my comments there. This one here, neat little business. I hope nuclear works, but for now, I would just be a spectator. Thanks for asking, Shadow Guy. All right, so let's take a look at the market. I think I've finished the stocks that were requested. If somebody wants to take a look at a stock and you are a member, feel free to ask. If you're not a member, $5 or $10 gets you some stocks. $5, you can ask for one stock. $10, you can ask for 3 stocks. So take a look at that. All right, so we've got the market is still down. No big deal, so long as it stays there. And one thing that I forgot to kind of show is the fear meter, and this thing's moving all over the place. It was at 4 a couple of days ago. It moved up to 16. Now it's back down to 9. Okay, interesting. I thought that the inflation data was a good report. It was a productive report. I think the Federal Reserve has the ability to lower rates now. They're like, hey, inflation's not a big deal. We can lower rates. So, how you doing, Nkiter? Good to see you. So we'll see where that bounces around. Taking a look at some of the big stories out there. So inflation, that's a good report. That's good news. That's very good news. All right. Let's take a look at the heat map. It's pretty red. Looks like consumer staples are back to performing well. The healthcare payers are doing well. All right. Not a big deal. Day after the market really roared, it's given up some gains. No big deal. I'm okay with it. The big caps, I know Apple is under a lot of pressure. It's been under a lot of pressure this year. And it slipped to the number 2 spot, and Microsoft was number 1. And now Microsoft's back to number 1. These guys are just flipping back and forth. NVIDIA is number 3. So these 3 companies have been bouncing around. Probably the more stable one of the 3 has been Microsoft. It's year to date's down 8.9, but the others are down quite a bit more. Amazon is down 15%. Google's down 17%. Meta's only down 3.62%. Very cool. So that looks interesting. Genetic Smite, thanks for the super chat. You want to take a look at Rolls-Royce. Yeah, I've looked at Rolls-Royce in the past. And this, I believe, is going to be the airplane turbine business. Let's take a look. Let's take a look at that. So and this stock, last time I looked at it, make sure I have the right one. So here it is. This is it right here. I think I've got the right one. So Rolls-Royce, last time I looked at these guys, and it's still the case, it's doing really well, up 69%, 5-year, phenomenal. These guys, like when we had COVID, this was not a great business because we weren't flying, we weren't traveling all that much. And then that created kind of a lack of production and a lack of airplane deliveries. And then all of a sudden we started traveling, and man, they really had to crank up the amount of airplanes that were being delivered, the amount of maintenance on these aircraft. So Rolls-Royce is developing, producing the turbines predominantly that go on these airplanes. So when we think of Rolls-Royce, we probably think of those really cool cars. But Rolls-Royce, the car business is tough. These guys made the intelligent move of saying, this is where the money's at, is in these turbines. These turbines, we make lots of money on them, and the margins are better. We have competitive advantages, and this is a very respected, company in that space. And they sold off the car business, I believe, to Volkswagen. Volkswagen actually produces Rolls-Royce cars. So those are separate entities now. So these guys are doing the turbines. It is a very good, and I guess motors for prop planes too. So that's what their business is all about. The stock has been doing really well. Let's take a look at it. We'll do an analysis on it. It's an industrial sector stock. It's in the aerospace and defense space. Now, they really had a pullback. Year to date, they're 22%. They had a pullback from $805 a share, and now it's at $696. We're dealing with a British pound, and let me see what the currency translation is. 129. So 129. All right. So I'll keep that as a note that I'm going to have to convert that. No big deal. And when I look at this market cap, this is going to be, so this all kind of add 30%, so to speak. So when we add 30% to this, it's closer to 70 billion, $72 billion in market cap. Revenue, 19 billion pounds. Okay. Forward P is 27. This is a stable industry. Now, one big picture headwind problem that I see is the travel industry slowing down. Delta announced their earnings, and they're saying that they're seeing very little growth. So that's the demand for airplanes is going to go down a bit. The other headline I saw, and the reason it caught my attention, is that I have a cousin that is going to take her family to Europe, and they were shopping fairs, and she and my wife have just been talking because they're going to go to Italy. We were in Italy in 2023, so there's a lot of sharing of experiences and advice. And I caught wind of this story that Air France is lowering their fares because they're seeing a big drop in travel from the US to Europe, and they want to fill the seats. So they're discounting the ticket prices. So that drop in demand eventually will get to Rolls-Royce. If there's a drop in demand for travel, we don't need as many turbines potentially. So I'll keep that in mind. All right. So moving on. Growth has been excellent. Look at this growth. And here's COVID. We don't need airplanes right now. Nobody can travel. Okay. But then, hey, we need airplanes. Get me some more of those turbines, please. And the growth is there. Now, the growth has been slowing down a little bit. It's slowed down to 12, but still good. Still good. All right. So growth is good, but it's slowing down. Free cash flow is stupendous. Look at that beautiful growth. They went from negative COVID, and look at that upward chart. I like data that looks like that. Now, I like that the data went up, but I'm not going to grow it a whole lot in the future when I get to the model, because again, I've got a couple concerns that travel is slowing down. And if travel slows down, we're not going to need as many airplanes, or at least to build as many new airplanes. So, all right. So we have 3,263. I'm going to have to add the 1.29. I'm going to give you my evaluation in dollars, if that's all right. Or maybe I can give it to you in pounds. I'll give it to you in both. How's that sound? So we're going to go both. All right. So, so genetics might They have a nuclear reactor parts for multiple European countries. I'm thinking, yeah, that's smart. So back in my controller days, I worked for a pharmaceutical company and we actually did pharmaceutical devices and we actually had 2 turbines in the production area that produced power and they also produced heat. And that heat we would turn into steam. That steam we used to sterilize our product. And I used to analyze those turbines and build models around the turbines. So I totally understand how a turbine manufacturer can also be a power generator kind of company. Um, and that's what we might be talking about there. I'll take a closer look. That you got me thinking there. All right, so income looks good, cash flow looks great. Balance sheet. Let's take a look at the balance sheet. Make sure they don't have a bunch of debt. So they have balance sheet. They have 5.7 billion in cash, 5.2 in debt. So they have a surplus of 457 in cash. And that is in dollars, by the way. That looks good. And cash flow, this is in dollars as well. Free cash flow, 3.2. So is this in dollars or is this? No, this is also in pounds. So we're going to keep it all in pounds. So this is in GBP. Okay. I'll try to keep it together. I'll try to keep it straight is what I should say. All right. So I'm liking the company. Let's take a look at a model. I'm going to open up another page over here and open up the same data you guys are just looking at, just so I can have my model open and then we can take a look. So I think of Rolls-Royce, it's an industrial. I'm going to compare it to 3M. And I was mixed between 3M and Union Pacific, but 3M makes stuff. Union Pacific doesn't make stuff. So I'm going to go with these guys. All right, bear with me while I get this thing ready for us to put in the numbers, and we'll be off to the races. And this is Rolls-Royce. So this is a pretty darn stable company. I'm gonna leave it at 8%. It's out of country, but man, I feel pretty good about this one. And currency, we're going to leave as GBP. Okay. So we're going to go with the cash flow last year. And again, I'm concerned about this slowdown in travel. So I'm just going to go with the cash flow they had last year. I'm not going to grow it. And then longer term growth, I'm going to grow by 5% and then 4%. Okay, I'm going to grow it by 5% just to be consistent there. I know that these businesses tend to have like spare part businesses and so forth. And there's probably a backlog of airplanes as well as turbines, and it's going to take them a while to catch up. So they're growing at 14% top line revenue, and that is slowing down a bit. So I'm kind of thinking through this on the fly here. Let's go 10% on that. That's closer to their actual growth rate. And I think it's going to be more accurate. All right. So they had positive cash, but I forgot the amounts. Let me take a look at where we were there. And balance sheet, we have 5,720,000,000, and then debt 5,270,000,000. The okay, so the market cap, excuse me, the shares outstanding are 8,390,000,000. Okay. And so these international stocks, sometimes I get the numbers or the ratios wrong. So let me kind of study this for a second here. So we have Rolls-Royce is trading on the London Exchange for $6.99. So the stock price is at 700 or so. London, okay. I was hoping they'd show me the share price. Here we go. So this is, yeah, this is in British pounds. So it's 699.20. Okay. Stock price. So this is 699. I use some features of Google Finance, and it does great with US based companies, but as you can tell with international companies, not so much. So this is shares outstanding. The other thing is shares outstanding. So we have 90. So market cap is 55.66. So and I'm not sure about shares outstanding 839. Okay. And I'm thinking through this because sometimes the stock analysis website doesn't give me the right ratios. So trying to get myself back into the right numbers. And that sometimes happens with international stocks, but I think I got it right now. Okay. So really comparing the equity value, 98 billion British pounds, and it currently trades with a market cap of 55,660. So there is a discount available on the stock. Okay. It's a really high performing stock. And maybe if I said, well, it's out of my home country, it looks like you're in London, so it's probably not the case for you, but that's where that stands. Now, when we look at earnings per share, I'm going to skip the earnings per share because I don't get that on my side. When I look at the stock, I don't get to see like the forecast for earnings per share on international stocks here. But looking at cash flow, this stock is trading below its intrinsic value. It's a solid stock. It's been doing great. It was a matter of when you look at Rolls-Royce, you know, sometimes these things that happen in our economy, and back here we had COVID. Let me see if the max will give us. Here we go. Perfect. So you see that Rolls-Royce was doing well. This chart shows that, hey, call it from the year 2000 up until before COVID, it was doing okay. And then COVID hits and holy smokes, nobody wants airplanes. Nobody wants airplanes. So the stock plummets 87%. Okay. Well, that's an opportunity because investors that bought in at that level are sitting there going, I'm flying first class because I made 17 times my money. If you were smart enough, lucky enough, wise enough to buy stock at that time, because we had an unforecasted, unexpected major event, a pandemic, and it causes the travel industry to completely shut down, and it causes that industry to completely shut down. And then the industry says, hold on a second, you got to turn it on full blast. And we got to we got to ship out as many airplanes as we can. And the demand just goes through the roof. So that became the opportunity. Now we can't invest just looking at the rear view mirror. We can't look backwards completely. I would say that as I look at this stock, I need to be a little conservative, if not a lot conservative, on what's going to happen in this industry. I think it's going to slow down to some extent because travel's slowing down, but then aerospace and defense is going to pick up in Europe, especially. So that's going to help. But I would say that these guys are going to be a slow grower going forward. I don't think they're going to hit 20% in the next 5 years. They're probably going to, creep down to maybe a 10% grower, maybe even get into single digit growth. But the company is operating well. They're making money, generating cash. So I think the stock's going to continue to work. Do they pay a dividend? They pay a small dividend. Interesting. Okay. All right. Man, you made me think on that one. Thank you so much for asking about Rolls-Royce. I'd been tracking the stock and man, why didn't I buy this stock? It's been a winner. But it looks good. Looks good. Maybe this pullback's an opportunity. Interesting. And there's a couple of these turbine manufacturers. The other one here domestically is General Electric, GE, and I forgot what they branded the company with. That stock's done great. Both of them have done great. So let's go back real quick to their businesses, right? So I think you mentioned you got civil aerospace. We understand that, and then power systems. Okay. So power generation solutions. So this is marine. How did it get there? The products. Yeah, this is similar to the equipment the situation that I talked about earlier. We had turbines. Those turbines generated power and then powered the plant that we had. And these looks like these are, I don't know what these are, maybe battery packs. So yeah, familiar with that. But this is not nuclear, by the way. I think I don't know if I read that wrong, but they're doing power generation, but these are more yeah, I don't know that they do. Maybe they do power nuclear power plant parts. I'm not seeing that. This I'm familiar with because I personally had an experience where we used two of these, and I had to do the modeling behind, you know, the use of these things because we would turn them on and turn them off so that we would optimize our cost. Good business, man. This is a quality business. I also like that strategically they were smart enough to know, let's get rid of the car business and keep the best part of the company, which is the turbine business. So, and they're making lots of money and market cap's good. So thanks for asking about that. All right. We dug deep into Rolls Royce. Let's keep going. Bad Omen. It's going good. Good to see you. And Kiter. Besides CBX, what are your thoughts on LMT? Let's take a look, Enkiter. So, so I guess I'll start with LMT, and let me just make myself a note. To update Rolls Royce later. Okay. So LMT, I don't have a valuation on it, and the reason I kind of removed it is that the stock just didn't have very good fundamentals anymore. Let me go through that. So they started to contract. Okay, that was a surprise. We have an aerospace industry that was supposed to start getting more demand, more budget, but that hasn't happened yet. And if we're seeing the quarterly contract, we're going to see this growth number contract. Their last earnings, their margins contracted, their free cash flow contracted. Let's take a look. That was my recollection there. So you see how their free cash flow was humming along? This is the quarterly, producing well north of $1 billion of cash, and then boom, that's not good. Earnings per share growth declined severely. Margins collapsed. It's like, whoa, hey guys, what the heck's going on? So their profitability collapsed, cash flow collapsed, growth collapsed. Well, hey, that's a reason for me to sell, and that's a reason for me to stay out until they figure that out. Because is that the beginning of something that's going to get worse? Could be. And I don't want to stick around for the stock price to go down another 50%. The market did not like that. And if we look at the 1 year, the market has not liked this stock. And they kind of deserve that treatment because I just showed you fundamentals. So when fundamentals paint this picture and then you go to the chart and it supports the same picture, okay, it clearly tells me Lockheed Martin has to fix their business. They need to get it right. And I'm not in the stock until they get it right. It'd be one thing if the discount was like humongous, like, oh man, I get to buy the stock at $100 a share. I'll buy it all day long, but it's a pretty expensive stock. So I'm staying out of Lockheed. And look at the 5-year, only up 24%. The 1 year, only up 2%. It pays a dividend, but the fundamentals scare me. I'd like to see 2 quarters of them getting it right because Lockheed is a slow grower. And the big picture was, aerospace and defense is going to benefit from a Trump administration. That may still be the case. But right now, man, they're cutting left and right. It's like, well, are they going to increase the budget for defense, or are they gonna cut it? I don't know. They might cut it. So those are my comments there. And Kiter, is I was scared away by the fundamentals, and the fundamentals are telling me this business is not healthy. It has started something bad, and I don't want to wait around and watch my capital go down in value. Forget that. Forget that. Count me out. And then Chevron, you asked about Chevron, and I'm patient with Chevron because it's an energy company and oil prices are down. It was working nicely for a while, and then not. Chevron's been up and down. I still think it's discounted. It has a terrific dividend. I'm a buyer of Chevron. The stock has really had an interesting chart for the 1 year. Look at this chart, down 14%. For a while, it really began to work nicely up until April 1st. And then it fell off a cliff. Everything we were working on fell off a cliff. Jeez. Year to date's down 3%, but it's predominantly because oil prices are down, but they're going to pick up. It's my expectation oil prices will increase. 5% dividend. This is a keeper for me, and I'm a buyer of Chevron stock. I'm buying into Occidental, and Oxy is really discounted. So I'm beginning to diversify my position in energy. You look at this stock chart. Whew, man. Somebody hand Warren Buffett some tissue because he's probably crying over this loss. Warren Buffett's a big investor in Oxy, and this was one of his big winners a couple years ago. It just looked like a genius move, and he's probably still sitting on big gains. But I'm buying into Oxy because I think once oil begins to work, like oil prices increase, Oxy's going to explode, and we'll see where it goes. But right now, I'm underwater on it, but I keep buying shares because I want to build a decent position of Oxy. Then I'll have Oxy and I'll have Chevron. Oxy has a smaller dividend. Chevron's a fully integrated big energy company, and that's going to be my plan there. Good to see you, Kiter. Hopefully you had a great trip. Genetic Smite. Okay, so you're 27 years old. Cool. I'm glad that you're putting this amount of time into investing. It's great. What I would tell a 27-year-old is try to find, like A-Lab, study stocks like that, or think about some stocks that can take your 10,000, British pounds and turn it into 100,000. That one stock can take that amount and turn it into 100 grand. So those are companies that are going to, really expand quickly. Rolls-Royce has been around, I think, over 100 years. It's an old company. It's a good company. It's a good stock. It might be a good solid stock for a portfolio for a 27-year-old, just to be a solid stock. But I would want you to wake up 10 years from now and you're like, man, I picked these 5 stocks and 4 of them made me a ton of money. One of them was a dog and I got rid of it. So that's the only other thing I would put out there. It's great to have you on the channel, man. So their equipment, UK submarines with nuclear reactors. Cool. I think Rolls-Royce is a good company. And just one thing on Rolls-Royce is back in the day, they created these big motors for these big engines for aircraft. 80 years ago when, we had prop planes and you had these military aircraft. Now we have jets, right? We have like these incredible jets where they can maneuver so fast. But 70, 80 years ago, we had these prop planes. So Jay Leno, and he has a car where they took an old Rolls Royce engine, I believe, and they put it in a car. And these engines are made for like a prop plane, a high performance prop plane. It produces like 1,100 horsepower. This thing's massive. It's a pretty incredible car. Jay Leno has like hundreds of cars, and that's one of them. All right. So let's take a look at the stock market. I don't think there's any other requests. I think we're good to go on that. If anybody would like another request, please, members, you don't have to pay anything extra. Just let me know. Or if you are not a member and you want to buy a super chat, feel free to. I'm going to close the chat. Close the live stream in 5-10 minutes if no other request comes out. But it looks like the market is going down a little bit from this morning. All right. Looks like we're going to be okay. So Bushy, could you look at Dow Chemical and then Accidental Petroleum? Accidental or Occidental? Did I mispronounce that? All right. I'll take a look at Dow and then I'll look at Accidental Petroleum. So Dow Chem and then Accidental Petroleum. All right. So let's take a look at Dow. I believe the symbol is just Dow, right? So Dow. Dow, through its subs, provides various materials science solutions for packaging, infrastructure, mobility, consumer applications in the U.S. And okay, cool. So they do materials, chemicals, right? A lot of the packaging, we don't think about it. We buy products at the store and stuff. These guys are producing material that made that packaging or other materials. They're a $19.4 billion market cap. Revenue is $43 billion. Forward P is 18. They are a material company, chemicals. Okay. Financials. Man, look at that year. 2023 had a really strong contraction. It looks pretty cyclical. You had growth, decline, growth, decline. Well, maybe they're going to start growing again. So pretty flat last 2 quarters. All right. So what's your stock price been doing? Has it been in rally mode or the opposite of rally mode? Down 53%. Well, this might be a nice discounted stock. Look at that. Now, this is, from first impressions, Dow, this company's been around forever and it's going to be around forever. They're just like, it's just a part of our, business world. So that is interesting. Okay. Let's take a look at their fundamentals. Okay. So we have a stock that has reasonable metrics on evaluation. We have a business that has negative free cash, but historically, look at that cash historically. Okay. So I'm going to use an average rather than saying, well, this represents all the future years. No, I'll take like a 5-year average. I'll go 1, 2, 3, 4, 5, and then I'll average it. So that's what I'm going to do for my free cash flow forecast. and margins are low. It's materials, but see this drop in margins? What happened? Like margins were up and down. Probably good part of it was commodities because they have to buy commodities to put into their products at times. So that could be a reason why their margins fluctuate, but we're just catching them when they have low margins. And that might be the cyclical. Remember, I was talking about how their business looks cyclical. It might be on commodities. If commodities are being priced so that they hurt Dow, you're seeing their performance go down. And if you see their stock do better and their performance do better, it might be the commodities are being priced in a way where they're taking advantage of maybe a situation just from a commodity price perspective. Okay, so low margins. All right, it's a materials company. Okay, so that's that. Let's see what analysts are thinking, and then we're going to do a valuation on that guy. So we have 14 analysts covering it. Some are quite optimistic, $56. Boom. Worst case scenario, we're only going to make a little bit. That's not bad. 54% average discount. So the growth in earnings per share looks really promising. This is why I look at earnings per share, because I think it is good to see where the forecast takes revenue. And it looks like it's going to be a slow grower, but it's going to be a grower. Okay. So I'm liking that. Okay. So let's get into evaluation. And I see you, Sabir. Thank you so much. GE Health. Let's do it. My wife worked at GE, by the way. So we're going to take a look at GE after this particular stock. We're going to look at Dow. And I've got it open on my other screen so I can focus on this screen. And on this one here, I am going to compare this one to 3M. And that's the second company I compare to 3M. I like 3M, the Minnesota Mining Company. So Dow, to me, is a low risk company. They've been around forever. It's a good company. Now we're getting into how we're going to forecast this free cash flow. And like I mentioned, they have a down year most recently. So I'm going to take the 5-year average, and actually I'm going to take a 6-year average. And I'll tell you why, because they have it seemed like they have 2-year cycles. Now I'm talking myself out of it. Let's see here. I'm going to go 4-year average. That way I take into account these cycles they've been on, because they've been on 2 years good, 2 years bad kind of cycle. And the bad years aren't so bad, but let's kind of take it like that. Okay, so free cash flow is going to be minus 354 for the negative cash flow year, plus 2504, plus 5270, plus 4593. And that gives me the total. Now I got to divide that by 4. So this will set up. This is the average, 293. Okay, so this is going to be a slow grower. We saw that. I'm going to grow by 5%. And I am going to increase this to 9 since they are having kind of a slump. We'll increase the risk. Now let's take a look at their balance sheet, see what that's looking like. So they do have a little bit of debt. Okay, so they have 2,570,000,000, and then they have $17,670,000,000 of debt. Okay, their debt to EBITDA is 2.74. That's okay. Shares outstanding. Let's make sure that's right. That is correct. So I have these formulas drawing it from Google Finance, and they got it right because it's a U.S. company. That looks good. Stock price 27. Yep, got it right. Okay, good. So the cash flows just on average with Dow tend to be far higher. I believe Dow is going to revert back to the business they've had over the last 10 years. Over the last 10 years, they produced free cash. So it's being traded well below its intrinsic value, in my opinion. Even if we said, hey, man, I want even a higher rate of return, that's fine. It's still going to be nice. But we're going into a lower interest rate environment. I think with the inflation report that came out, we're going to see the Fed reduce interest rates and we're going to see rates go down. All right, now let's update the earnings per share and see what that's going to reveal. And earnings per share for this year is $1.94. It's going to grow nicely in the future. Now, this is a materials company. I'm not going to dream and think that the market's going to pay up for companies like these. I'm just going to go with the 12. Overall, this is a discounted business. And I think it's a low risk business because this is just a necessity in many industries. It's not overpriced. It's actually the opposite. The stock's been hammered. Stock's down 53%. Dividend yield 10%. Wow. That looks pretty good. I missed that one. Dividend at 10%, huh? Yeah. So when do they announce? April 24th. That's around the corner. This looks like an interesting stock. And this is a, if we have and I don't know how tariffs are going to affect Dow because I think a lot of the product they're producing is probably going to China and is being produced in China and being put into that manufacturing supply chain. They're going to go where manufacturing happens, and that's where Dow is going to show up. So this one here, if you are optimistic that they're going to revert back to what they've done in history, this one is going to perform because you see that like 5 years ago, once stock starts to work, it starts to work. I think we're going to see this again. I don't know if it's going to happen immediately, but boy, they come out with a good earnings on the 24th. This stock's going to do well. If they keep that dividend, even if they cut it by 50%, still a really good dividend. So interesting proposition to the investor. It looks pretty attractive to me, I must say. And it's in a space that I've been trying to grow my diversification in. I have a ton of tech, communication services, and so forth, but I don't have a ton of materials companies. I'm trying to grow that a little bit. And these guys are setting themselves up pretty well. I should say the stock's really undervalued. Thanks for asking. I hadn't looked at Dow in a long time. It looks really, really valuable. I'm liking a lot of things I'm seeing. So let me add that guy to my watch list. I have some members of the community. They like dividend stocks, and I got to think Dow's looking pretty good. That type of investor. You have a strong dividend, a discounted stock. If it starts to work, great appreciation. In the meantime, great dividend. You get your cake and you get to eat it too. All right. Thanks for asking there. All right, Sabir, Bushy, thank you for your support. And I see a couple of people have done a super chat. I appreciate it. It's $5 for a stock. I'm let it slide. But this will be the last one at $2. Going forward, it'll be $5. So let's talk about GE Health. All right. So we talked about Dow. We talked about Lockheed Martin. So we have GE and then GE Health. So this one here, which business is this? Because they split it up into like three things. So this is GE Aerospace. This is similar to the business we just saw in Rolls-Royce. When you talk about Rolls-Royce and you talk about GE, these guys are competing with one another. And I think there's Pratt Whitney is also manufactures turbines. Those are the three I can think of. 18% up, 5-year, right there with Rolls-Royce. Let's compare it to Rolls-Royce. Look at these stocks. They were made for each other. They're right there with each other. And it's based on that, like, how I explained that travel contracted due to COVID. We didn't need that many airplanes. And all of a sudden, hey, we need a lot of airplanes. Boom. So the one thing I would say is on GE and Rolls-Royce is it going to begin to kind of come back down? It could, because it's a pretty good appreciation rate. I mean, these are great appreciation rates for what historically hasn't been like a high growth space. General Electric flew up. This was like Apple-like kind of company, and then it contracted. I mean, look at this contraction. And Rolls-Royce followed more of what you would expect out of a chart. But you see how the most recent appreciation has been really prosperous. Well, to me, that's a little bit of a risk. Is like, well, am I going to be waiting a long time for a return? Because a lot of the value that was expected from the stock is being priced in the stock. So just that would be a concern for me, is like the price seems a little expensive. Let's take a peek and see what the fundamentals tell us. So this is a $197 billion market cap company. You're paying 5 times revenue. Forward P looks a little expensive, 34. Dividend is low. Analysts think it's a buy, but it's only discounted by 14. And here we see a lot of red followed by green. Now they're growing. Quarterly looks good. 14.3% looks good. Now, part of what's a little difficult is GE several years ago was really a combination of what now is 3 publicly traded companies. So I think when they divested the other 2, I guess, the numbers are hard to compare, the current numbers against the historic numbers. So that the growth looks good. The most recent quarter looks really good. Free cash flow is okay, but Rolls-Royce, the market cap was, and it was in British pounds, which is 30% higher, but that was like 55 billion in market cap, right? So, well, I have the valuation. I'm just saying that Rolls-Royce is producing higher free cash flow if you were to compare it to its market cap. This cash flow here, based on its growth rate, I would value the company at 72 billion, maybe 80 billion minus debt. Let's see how much debt they have. So they have $6 billion of debt. So it's like the free cash flow is maybe 80. This is an $80 billion value company. And they are priced at 197 billion. So these guys look really expensive. Now we just did Rolls-Royce, so let's take a peek and compare this one to Rolls-Royce. But I think I'm going to arrive at Rolls-Royce is a better deal because they're very similar businesses. They do turbines predominantly, and GE also does those power plants. So let's copy this guy. See how Rolls-Royce, and this is in a higher value currency, 3.5 billion. And General Electric's going to be in US dollars. And it's going to be less valuable. All right, so I'm going to open up GE on my screen that you guys can't see, just so I can look at one screen and update the other. So on the free cash flow, they did 3.6 billion, and I'm going to go grow it by 10%. Okay. You see how this, because you need to add 30%, because this is in the British currency. You add 30% to that, you're up there at 4.5 billion versus 4 billion. So immediately there's better cash flow here, but the market cap is much lower. This market cap is actually this is in US dollars, 71.8 billion, because this is in British currency. You're still getting a better cash forecast out of Rolls-Royce at a lower price. Okay. So it's good to compare companies and see which one is the best one to buy. Let's take a look at the balance sheet on this guy. And so cash, 14,200, and then 2238. So the equity value is 104. Now let's take care of the market cap and stuff. So this one should work on. Okay, and then we got share price is incorrect. No problem. So it's General Electric based on free cash flows is priced 47% too high. It's 47% above its intrinsic value. So General Electric's a sell, Rolls-Royce is a buy. And it's a perfect comparison. These are very like businesses. This guy's producing higher free cash flow, but its market cap is much lower. This one, the market cap's well north of double the market cap of Rolls-Royce, and its cash flow is lower. So it's General Electric's a sell. It's priced too high. And those charts that I was showing that over the last 2 years, the stocks have really increased. Well, I'm more concerned about GE than I would be about Rolls. So now let's look at the forecast. Earnings per share is just barely showing a discount. So $5.60. You're getting a better earnings per share ratio on Rolls-Royce. PE of 18. All right, I'm good with that. And then grow this guy by 5%. So even on an earnings per share ratio, it's priced too high. So this is just priced too high. General Electric. And that's where we have it. My wife owns General Electric stock, so I better watch what I say, or I may be sleeping in the doghouse. But she's been happy with the returns. All right. So that's GE. Good one. Good compare against Rolls. It helps both the Rolls-Royce, the person that's interested in Rolls, and GE. Because if you're interested in Rolls, it kind of bolsters your confidence. Like, hey, this is the better of the two. GE, you got to pump the brakes. Hey, if you want to be in this space, there's a company that might be better priced. Howard Marks, it's not what you buy, it's that you buy it right. It's not what you buy, you got to buy it right at a discount, not at a premium. Howard Marks. And I know a couple of the guys in the channel have talked about Howard Marks, how they liked him. I was not up to speed on Howard Marks. I studied him. The guy is good. Incredible value that in what he speaks about and his memoirs. Very good stuff. You ought to study them. If you have the time, I think it'll make you a better investor. All right. So thanks, Sabir. Hopefully that helped you understand General Electric. I appreciate you asking about that. All right, everyone. Cool stream. Thanks so much. And market's selling off a little bit. And we've been shell-shocked when I'm saying it sold off a little bit, 3.4. I mean, that's nothing. It went up 12% yesterday, but it went down like 8% on Friday. So let's see. I think there's some selling because some stockholders are like, hey, well, if the price is going to be this high, I want to create a little bit of cash because we just went through this freaking storm of the market selling off violently, just violently selling off 24% on the NASDAQ. So, hey, let me create a little cash. And if we go down again, I'll have some cash to buy. China tariffs are now 145%. Man, that's not good. That means iPhones are going to be pretty soon. They're going to be like $100,000 for an iPhone. Just joking. Well, that's not good. Come on, China, US. Can't you guys get along? Just hug it out. Hug it out, guys. Come on. Stock market depends on you guys getting along. All right, cool. Well, that was a fun stream, guys. I'm going to stream tomorrow morning unless something comes up because those earnings are coming up. I'm telling you, the earnings tomorrow, this is like big. This is huge, okay? And this is going to set the table. And then we're going to have tech earnings from the big giants. That's going to move the market. And it's going to be an interesting morning. So I'll make sure that I have time to stream for a couple hours. Same rules apply. Thanks so much for all the super chats. Thanks so much for all the members. We're growing our members, and it's really cool. We got some new members. Really appreciate you guys joining. Some fresh eyes, some fresh minds to talk about stocks. We've been uncovering some really good stocks. I could thank the community for some of my big winners that in kind of patterns that we followed today, I like look at some of these companies and go, yeah, that's a good stock. I'm going to buy it. And I think it's been really productive. So I appreciate you guys. Hopefully you guys are going to get a lot of value. And that is it for today. Enjoy your Thursday, and I will hopefully see you tomorrow. Take care.